Hi, folks. This is Adam Taggart, co-founder of Peak Prosperity, back for another week of talking with the lead partners from New Harbor Financial, the financial advisor endorsed by Peak Prosperity. We're joined again by the lead partners, Michael Preston. Hey, Mike, good to see you again this week.
Hey, Adam. Thanks for having us back.
All right, and John Lodra. Hi, John.
Hello again, Adam, and hello, Mike. Haven't seen you in the office in a while.
Been a while.
Yeah, here we all in lockdown. I'm fresh from the shower because, of course, you got to get cleaned up to do these Zoom calls here. All right, guys. So you've been kind enough to take time away from your screens and your client calls weekly. You've been doing this for the past 4 or 5 weeks with us to help keep folks abreast of where things are in the markets. We started doing this when the markets had their massive meltdown in late February. Not too much has happened to the market since we last talked. In other words, they've sort of begun plateauing, it looks like, a little bit of up and down, but for the past couple of days, looks like they're down about 2-3% since we last chatted. I did want to quickly raise some of the economic data that's come in since we last talked, though, because it continues to look pretty grim. The initial jobless claim reports continue to be in the millions. It was just released earlier today that about 4 million people filed for unemployment for the first time last week. So that in total over the past 5 weeks gets us above the 26 million mark. I'm putting up a chart here right now that just sort of shows how historically aberrant this is. So we now have 26 million people that we know of who have lost their incomes and are looking for work and seeking at least temporary relief. All right, so you've got those job losses. Let's compare those now with the Purchasing Manager Index reports that have been coming out, the initial April reports. First, we'll put up the one for the US. If you're unfamiliar with the Purchase Manager Index, or oftentimes called the PMI, a measurement of 50% basically means an economy that's in balance. If it's north of 50, that means the economy is expanding. If it's south of 50, that means the economy is contracting. You'll see here historically, we kind of hover around the 50 to 55 range. The latest data that we're seeing has plummeted down to 27. Shows the economy just in violent contraction. We can compare that and see similar indications in the Japanese PMI, which has made a similar drop from the around 50, 55 range down to about the same high 20s, 27 range. You look at the Eurozone, God, it looks even worse, from that same 50 to 55 range down to about 13.5. So we're just seeing signs of a huge demand evaporation and economies running at a fraction of what they were running at just a few months ago. That demand destruction is reflecting now in certain markets, particularly the oil market. I think you had to be sleeping under a rock if you didn't see the news this week that oil prices went to their lowest in history. Oil went negative just a couple of days ago on April 20th. It's the crude futures set a record negative $40.32 a barrel. That has recovered slightly, but basically this is showing that the economy is just it's collapsing. It just doesn't need the oil and the energy that it normally needs because the economic activity just isn't there to justify it. And so what's happening right now, particularly in the oil market, is there's a massive glut. The industry just wasn't prepared for that type of drop in demand. And the way the infrastructure is set up is you can have supply overages very quickly at different parts in the supply chain. And right now there's just nowhere to store it. And so people who own these futures contracts are basically paying people to take them off their hands. Similarly, we look at housing. Housing starts, new home starts, just had their biggest drop since 2013, which was, coming out of the aftermath of the great financial crisis. March showed the biggest drop ever for any March in history. Again, indications of the slowdown in activity. So guys, I wanted to go through those charts just to set the context for my question to you, which is, we've been sort of mapping this on a week-by-week basis as the data's begun coming in and showing that, yeah, the economy indeed is really getting impacted by the coronavirus. But the stock market, since it put its bottom in several weeks back, had been doing nothing but rising until just a few days ago. And now, like I mentioned earlier, it's sort of hit at least a short-term plateau. Is the market just not gotten the memo yet? And if not, what is keeping prices where they are? Is it all about the stimulus that's happening worldwide? And if so, is that sustainable, or at some point do the prices have to start mapping to this worsening data that we're seeing coming in? John, Mike, I see you smiling there. Let's start with you, and then we'll head over to John.
I guess I'm smiling because I don't believe that the bounce is going to be permanent. Nobody knows for sure, but we've had a record amount of stimulus injected into this economy. $8 trillion is one number I've recently heard. Both central bank stimulus, money printing, and fiscal stimulus that has been thrown into the market, thrown into the economy to try to keep things up. I mean, the economy is showing really destruction of demand. It's deflationary forces that we see at hand right in front of us. The collapse in oil, and really what we think the Federal Reserve and other central banks have been fighting is the deflationary forces by continuing to print ever more money to keep the jig up, if you will, to keep it prices high, because prices can't come down, otherwise everything kind of comes crashing down. It's a debt problem that we have. So $8 trillion has caused a major bounce from the March 23rd low. We think that it's a typical retracement that happens after a fast bear market. In fact, this is one of the fastest and deepest bear markets that we've ever seen, the fastest 30% decline really in history. Certainly, very similar to what happened after 1929. The upward retracement after the first drop is often the largest retracement of all. We certainly have seen that. The S&P's retraced a little over 50%, the NASDAQ 62% or so, and some of the FAANG stocks are right up near, or the FAANG index is right up near its all-time high. So the long story short of it, though, is we do not think that we're right back to the old way. In fact, if you look at valuations of the market by a lot of measures are actually more extreme now than they were then. S&P earnings I was just reading are somewhere around $140 a share, and they'll be lucky to be at $120 a share a few weeks from now when some of these companies come out and report. And they'll probably end up being much lower than that. We think that there's a major underestimation of the demand destruction in the economy. And the market is literally just totally ignoring that right now. And we urge people to be cautious in our portfolios. We're still completely out of the stock market, and expect much lower prices ahead. Okay,
John, I'll give you a chance to add on to what Mike said. In terms of your outlook here, how does the market need to get the memo here?
Yeah, I think it does. Folks that might be listening in that don't consider themselves particularly much of an expert in these matters or even educated. A lot of folks feel a little bit, in the clouds. I'll just tell you this. I mean, the market still remains, certainly with the recent, even with the recent pullback and the destruction in earnings we're seeing, hands down, the market remains the most overvalued relative to underlying earnings and profitability and things like that in all of history. So, it doesn't take too sophisticated a financial analyst to kind of do the calculus here that, it'd be laughable to say the market has priced in what's upon us. It's just simply ludicrous to think that. It's been levitated on distortions and psychological rebounds here, but, by no means do we think this is priced in. And, a prudent investor, we think, is very wise to step aside and wait for much better values and reality to get priced into the market, frankly.
Okay. And John, we're about to be, I guess we've just started entering into Q1 earnings season, where companies are beginning to report Q1 earnings, which is the first quarter that's been impacted by the coronavirus. Really, it was only the back half of that quarter. Q2 probably is going to be an awful lot worse. So do you see these potential earnings calls as a wake-up call for the general market, meaning it's one thing to get excited of sort of the news of more stimulus and whatnot, but as the data begins to come in, like the macro data I just showed, but also the micro data begins to come in that company X is, lost a horrific amount of money over the quarter. Do you think that's going to create a psychological wake-up call for the market?
Yeah, I think there's a couple of things that we're likely to see here. First of all, a lot of companies are starting to yank any guidance whatsoever going into the future. So, we can use the market cliche that markets hate uncertainty. You get companies starting to yank guidance of any sort going forward. Never mind, the opaqueness of what's currently on their plates. But a lot of companies can't see next quarter, never mind, or next month, never mind next quarter. All right, so that's certainly, I think, going to be a shock to markets. But also, you've had, it's a pretty known fact that there's a lot of, accounting gimmickry that can be done to fabricate or dress up earnings to meet certain, quarterly objectives, this and that. And it's a pretty common phenomenon that when the economy and markets hit a broad skid, that's when CFOs and CEOs think it's their opportunity to come clean, if you will. I'm not alleging any illegal activity here, but certainly there's bendings of perspective and truth sometimes. And so I think you're going to see a lot of throwing the kitchen sink in here, where every CEO, CFO now has the cover to come clean on every little bit of dirt that maybe they've been stepping around, because everybody's doing it, and this is their time to take cover. So I think we're going to see some just ugly reports, not only not being able to look forward, but they're going to be coming clean on a lot of stuff that's been just swept under the rug.
Yeah, I'm glad you mentioned that. It's not necessarily legal activity, but every CFO is deferring expenses or they've got losses that they don't yet want to realize. But when times get bad like this, you want to push everything out there, knowing that, hey, if it's going to be a bad quarter, let's just make it a bad quarter and get through the pain, right? So, I think it's a great point that you brought up there. And it is interesting, too, that several of the earnings calls that I've listened to, the executives refuse to give any guidance going forward. Hiding behind the guise of, hey, we just be guessing, nobody knows what's going on with the virus, there's too much uncertainty. But it is a little bit of a crazy world where we're supposed to be valuing these companies and we have no guidance to base it on, and nothing but increasing uncertainty out there. So, I think of all that, and I just have a real hard time trying to make the bullish case for why stocks should be back near valuations that they were just 2 months ago before we'd all heard of the virus, right? So anyways, I'm glad to hear that you guys are still defensively positioned. Let's talk about a sector that maybe bucks a little bit of the trend of what we're talking about here, and I'm specifically thinking about the precious metals, where I think for us over the past number of years, it was a bit of a head scratcher with all of the global QE that had been going on and whatnot, that the precious metals didn't perform better than they did. But they seem to be performing pretty well here. Obviously, in theory, they're supposed to be a good defense against inflation, the textbook of definition of which is an increase in the money supply, which is what QE is. And Mike referenced the 8 trillion that's supposedly been printed up worldwide over just the past couple of 2 months or so, maybe even less. Mm-hmm. What are you guys seeing happening in that complex right now? Do you think that this is a sustainable run? I did hear, can't remember if it was this morning or yesterday, but Bank of America came out and made a call for $3,000 gold, which was shocking to me, mostly because gold is generally kind of a ridiculed asset, or at least a poorly treated asset by the establishment. The banks usually like to try to lowball what they think the gold price is going to be, but this was a pretty robust prediction, and it was coming from a mainstream, bulge bracket bank. So, Mike, why don't we start with you, and then John will ping pong back over to you. What are you seeing right now going on with the metals, and maybe comment on what impact it's having on your portfolio? Because I know that the New Harbor portfolio, while out of the market, you were saying, Mike, I believe you do have some exposure still to the metals and to the miners. Comment on if it's having any sort of noticeable impact on the portfolio, and if this is something that you feel has real legs here.
Yeah, my comment about being out of the market is more specifically net flat equities in general, the S&P 500. We do have a core position in mining shares, and that's a position we've had for quite a while. We've had various different hedges on that position from time to time. We even now we have a hedge on our mining exposure, but it continues to be one of the, probably the best sector we think for potential future gains. It's tied, of course, to the price of gold and silver. Gold itself, if you look at a long-term multi-year chart, breaking out near all-time highs, not there yet, but it's breaking out of a large consolidation. Silver is lagging a little bit. Silver is a dramatic value, we think, at these prices, at a ratio of about 113 to 1 or so, silver to gold. That's pretty historic. We thought it was pretty crazy at 85 to 1. Now it's about 113 to 1.
Yeah, I think it's very historic, right? I mean, it's hardly ever been over 100 in the entire record. And now I think it hit a high of like 123, but you're saying it's still around 113 or so now?
Yeah, about 113 when I calculated it yesterday. It did hit almost 125, but we're pretty close to record levels. And, so we're talking to people all the time and saying you may want to weight your purchases towards silver if you can, or at least make sure that you include some of that in there. But the mining shares still are very undervalued here. They went through a long bear market. The price of miners is leveraged to the price of gold and silver. So if we're bullish gold and silver, and then we should be bullish miners. Miners, though, still are relative to the XAU mining index, price levels, still very undervalued relative to the price of metals. They just really, really underappreciated that sector, and all of a sudden it seems like the whole world is waking up and saying, "Oh my God, let's take a look at the mining shares." I mean, they had a sharp drop last month. GDX fell from around 30 to 16, and GDX is an ETF, an exchange-traded fund that owns gold mining shares. That fell from 30 to 16 and has now rocketed right back up to 33. We think that it could reach 40 in fairly short order if it continues to build on this breakout. So we maintain a core exposure to mining shares somewhere around 10, 15% plus or minus, depending upon client portfolio. And so that is indeed exposure to the market, I guess, the stock market, since they are stocks, but they behave completely different than the stock market. So, that's kind of why we take that out of the stock market exposure calculation, usually when we're describing it. But we think that they've got legs to run. We continue to hold out of the money puts on that position should we have another sharp pullback. But we think there's some legs on the rally.
All right. You mentioned a couple of things I want to follow up on. First, you mentioned the hedges that you have in place on your mining positions. And I just want to help people understand who might not be entirely familiar with your model, how that works. You guys are essentially using options to put downside insurance on the portfolio, meaning if, let's talk about GDX, which you were talking about. That's a portfolio of the major gold mining companies. If that index were to fall, so you mentioned that it fell from 30 to 16, right? Mm-hmm. If you have a hedge on that position, there's some price at which once it falls far enough that once it's crossed your hedge price, you're losing much less money on that position because you basically bought that downside protection. That's in general how it works, right?
Yeah, that's right, Adam. When GDX did fall from 30 to 16, we had puts on that position. We had, I believe it was 27. I think the puts were 27 in the May expiration for the puts. So if GDX is trading at 30 and you've got to put at 27, that means any price below 27, you don't experience that. You always have the option to sell or put your shares at 27. And so when that happened, it defrayed a lot of the downside risk for us. We did go ahead and adjust that put down to a lower level. We went down to 22 at the time to take some profit out of that put position. Now with the sharp rebound, we've moved that strike or that protection back up. Presently, we have a June 25 put. So with GDX at 33, we have a put at 25. That's still $8, so that's a good 25% or so below here. But we're less worried about a sharp pullback certainly now than we probably have been for quite a while after that shakeout that we just saw. We'll continue to adjust things. We won't always hold put protection because it is expensive. But given the potential that we see in this sector, we're okay with paying a little bit of money for insurance. And that's essentially what the puts are, basically insurance on the position.
Great. And what I like about that is as your core position rises, so GDX goes from 30 to 35 to 40, as you mentioned, you can be increasing the price of your puts, right? So that as it's increasing in value, you can start protecting more and more of that value as time goes up. And what's nice is you can rationalize paying for that additional protection because your core position has been making more money as well. So the reason why I'm going through this is to show that one of the main reasons we recommend you guys is for your risk mitigation, and that's one way to mitigate against losses. But also because of this question, which I'll direct to you, John, the mining shares went down when the market corrected, and in their defense, pretty much everything went down. But you could say they behaved more like a general stock early on, but they've rebounded quickly, but so has the general market. So my question is if we get the market downturn that you guys are expecting to happen, next, which is why you're out of the market on your other positions, do you expect at some point the mining complex to decouple from the general market?
Yeah, I think they have already. And I think one of the main reasons why GDX, if we want to talk about that again, went from 31 to 16 and now back up to closed at 33 and change today, got as high as 34 and change. I think one of the main reasons we had such a sharp rally that's a doubling, over a doubling in a very short period of time. The broad stock market hasn't done that. And I think that's a couple of things. I mean, they are an undervalued sector, okay? We'll talk about that in a second, but we cannot ignore what has been done in response to this market weakness and economic weakness by Federal Reserve, central banks, and Congress. We have unleashed a massive money printing kind of monetary fiscal stimulus attempt that has folks rightly concerned about monetary inflation type things, but also real concerns about the sanctity of currencies that are being undermined by really short-term and perhaps careless and reckless fiscal maneuverings to stomp out the burning fire. So gold itself and then certainly the gold mining stocks are responding to that, I think, in a very powerful way. Let me talk about quickly the valuations. Let's forget about these companies as, let's just think about them as commodity companies. Okay, we have oil companies, for example, that are commodity companies. We know what's happened to the price of oil, and we know most folks, and especially those that own oil companies of various sorts, know that those stocks have absolutely gotten hammered. They've gotten hammered because the price of the commodities gone down tremendously, but probably more so because the balance sheets of these companies are hugely indebted, and they are existentially at risk of massive bankruptcies and implosions. So these stocks have been punished. If you look at the opposite, gold mining companies, the commodity price has been rising and is projected even by the likes of mainstream folks like Bank of America to rise tremendously from here. And I would say they're probably even being a little naively low on the price projection there. But you also have companies that have done tremendous work to clean up their balance sheets over the last decade. Gold mining stocks have a really attractive multiple to free cash flow. These are cash generating companies that they have a real high degree of what's called operating leverage. Simply increase the price of the commodity that they sell, and you get a tremendous boon to the earnings of these companies. So you could have these companies' share prices go up really dramatically. And of course, one thing every company has to be thinking about coronavirus and its impact on their operations and workforce. So we're not at all naive to that being a possible risk. Our best research right now tells us that about 10 to 15% of global gold mining operations are shut down or impaired in some way by the coronavirus, which is a very small percentage. And important, these companies have the free cash flow and the stable balance sheets to weather very nicely even a further disruption to their workforce. Anecdotally, I think it's important that, for example, Canada classified gold mining companies as essential businesses. That may come at a shock to a lot of people, but the global central banks themselves look at gold bullion and other precious metals as very important parts of their backstop of stores of value. So Forget the fact these are gold mining companies for a second. They're highly profitable companies right now, selling a commodity that is likely to rise significantly in price, and they make for a good investment, is what we feel.
Okay, great. And obviously the underlying gold tends to perform well in times of uncertainty because people are looking for security and stability. And if you get the second market downturn here that you're expecting, that just adds to the instability, uncertainty picture, and therefore, gold should do well, and obviously the miners hopefully will buck the markets and continue higher. I know we've been waiting for this moment for a long time, as you mentioned, because the miners are leveraged to the price of gold. When gold and silver do well, the miners can do exceptionally well. Both you guys underscored the fact that the miners had a pretty tough decade. You called it a bear market, Mike. I think you were being generous. I think they were probably the most hated asset class out there for many years running. So it's nice to hear the optimism in your guys' voice that those of us that have been kind of slogging through the long, hard winter, might be seeing finally shoots of optimism for that moment that we're hoping for when these guys really do take off. I know you guys generally work in the index funds like GDX, et cetera. Correct me if I'm wrong, but you don't get so much into buying the individual miners. And I'm only mentioning this because the individual miners are incredibly risky. But I know that in certain cases, when this sector does do really well, you can get individual miners that go up hundreds to thousands of percents relatively quickly. Is that correct?
Yeah, that's correct, Adam. We tend to stay in the entire sector. There was a guest on one of your webinars a few months ago. I actually can't remember who it was, but we liked what he said, and he said, make sure you get the beta exposure first and worry about the alpha later.
Yeah.
And beta is what beta means is exposure to the whole group, the whole sector. Just being exposed to the whole group is going to be enough, certainly enough for us for the most part, because that's 80 or 90% of the whole move. Now, if you want to be ambitious, there's people out there that will pick individual miners or small micro cap miners. It's just not really what we do. We don't think it's necessary for what we do. And our portfolios have seen really good gains just being exposed to the sector. And that's probably where we're going to stay.
Good. Yeah, I think it was Rick Rule that you were referring to, right. And on individual miners, just to underscore our perspective. It's almost akin to going to the casino, right? It should only be playing with individual miners with money that you can highly afford to lose. And what you want to do there, at least our recommendation is you want to work with somebody who their full-time job is understanding these companies, talking to the management, in many cases, going out and doing on-site visits, exploring the mines, et cetera, because there's so much uncertainty and risk in that scenario that, even in the good times for the industry, there's a huge amount of these mines that just will never be profitable and won't pan out. And so it's a big gamble, I guess is what I'm saying. So I would stick with what you guys are doing. It's much, much easier and safer to go after the beta. And if you've got a little extra money you want to speculate with that you don't mind losing, find somebody like a Rick Rule or Brian London or somebody that publishes their own gold newsletter and focuses on these stocks and has their top 10 list that they're continually updating. All right, with that being said, guys, I know we got to hop quickly. I mentioned real briefly what was happening with oil. Is that just curious your guys' outlook? I know you look at the energy sector. I know at some point you will probably want to deploy capital there when valuations are better. Given what's going on right now, are you just watching? Are there certain opportunities you're seeing emerging? Any commentary on the oil?
Yeah, I'd be happy to comment on that. In fact, we actually just talked yesterday about trying to make some sense among the rubble there. That's a classic bottom fish play. These stocks are getting punished for good reason, right? Their demand destruction is there. The future is very uncertain in terms of when that demand comes back, in terms of the demand for oil and prices to rise with that. But these companies have tremendously risky balance sheets right now. There's going to be some companies that are forced to go bankrupt, forced to submit to a hostile takeover by a stronger company. So if we were to start to toe dip there, it'd be purely not because they're in good shape, but perhaps because we feel like they've been oversold. But we would likely do so with some very robust hedges. And as tempting as it is to think that this is a washout sale and load up on this, likelihood they're going to rebound in a rocket ship way. That could happen, but there very well could be some really challenging times ahead for that sector, even though it may feel like they can't go any lower.
All right. Well put. Well, that's a great underscore for why we recommend people work with a financial advisor like you, so that they can take some of the emotion out of the decision process and come up with a plan that maybe, sort of as you're describing, John, toe in the water and then flights in if the thesis begins to prove out. And if not, you're keeping your powder dry for the better opportunity when it presents itself. All right, guys. So wrapping up here, because I know you have clients to talk to. Thanks again, guys, for taking time to share your insights with us for another week. We'll keep doing this for as long as the markets keep us on our toes here right now. As we normally do, when we edit this video, we will put the URL for how folks can contact you. The way we've created the relationship with you guys is because we have so many people that contact Chris and I and ask if we can refer them to a financial advisor who thinks like we do at Peak Prosperity and looks at the world through a similar lens. That's why we've created this relationship with you. It's been going on for about a decade. We've sent thousands of people your way. You've been incredibly helpful for them. But what we've offered through this partnership is that anybody who has questions, would like a portfolio review, would like to get your opinion on how their assets are currently situated, what exposure they might have, they can schedule a consultation with you, free of charge to them, no strings attached. They don't have to work with you. It doesn't cost them a dime. And we've worked this out because of the long-term relationship we've had with you guys and your guys' extreme generosity in being willing to do this. Just underscoring too, we do have a business relationship with New Harbor. We have to be able to send people like you over to them in an SEC compliant way. If you click on the URL that's there on the screen, it provides all of the details about that relationship. The core thing to know is because of the relationship, you're not paying any more. In other words, if you end up working with the guys at New Harbor, you like them, you're not paying anything more because of the relationship with Peak Prosperity. In fact, you're probably getting more attention from them. But if you walk through the door, you'd be charged the same rate from them. All right. And, real quick underscore, we very much value the tremendous insight that these guys provide, the incredible emotional support that you guys have had to do with so many people we've sent to you recently who have seen, especially a month ago, had seen a third of their portfolio vaporize overnight. I just want to underscore, we're sort of agnostic whether you work with New Harbor or not. We just want you to work with a professional financial advisor that takes the risks that we have been talking about in this video and talk about in Peak Prosperity into account when putting together your portfolio strategy. If you already have an advisor who does that, that's fantastic. Stay with them. But so many people come to us telling us that they don't, or that they're having a lot of trouble getting their advisor to engage on these issues, and their advisor is just giving the old, buy and hold saw, whatever. So if you fall into that category, there you go. Just go to greylockpeak.com. That's the website where you fill out a quick form and get referred to these guys. And they'll get on the phone with you and see if they can help you. All right, gents, with that said, look forward to seeing you next week. We'll do the same thing at the same time and keep doing what you're doing. Thanks so much, guys.
Thank you, Adam. Have a great evening, and we'll talk soon.
Thank you. Talk soon.